in this little section, I'm going to focus on debits and credits. Now, when people do accounting, that's usually the thing that frightens them the most. So let's now not let this frighten us anymore. In study unit 2 and 3, we learnt about the different account names: bank, debtors, water and electricity, and so on. So what are those accounts? Let me quickly explain to you. Each account basically has its own page. You'll put the account name at the top. You'll underline it. It's very hard so far, hey? Then you'll split your page down the middle. Also not so hard, hey? And you're going to call the left side debit and the right side credit. Now you say, but where's this? What's this DR and CR? Well, let's start with that. DR stands for debit. CR stands for credit. I don't understand why debit has an R as a DR as an abbreviation, but you know what? If you want to put DT and CT, that's fine. Okay, but that's the general way that they abbreviate debit and credit. Can you see those blue lines? Looks like a T. So can you see why they call them T accounts? No other fancy reason, eh? And all that means is, in your Latin language, debit means left. Credit means right. It does not mean increasing or decreasing, receiving or losing or paying. Let me just write that so you can actually read it. It is your left-hand side and your right-hand side. Nothing more than that. You can see them marching in the army. Debit, credit, debit, credit, debit, credit, halt. Okay, left, right, left, right. It's got nothing to do with accounting. It is a language. All right. When we did study unit 4's double entry exercises, the class examples 4.1 and the tutorial 4.1, I gave you some steps. I said the first thing you do is you identify which the two accounts are, you classify them as assets, equity, or liabilities, and then you show the effect, and that's what we did in study unit 4. And then I said when we get to it later in study unit 5, the double entry principle says for every account there must be 2 accounts affected, or for every transaction, sorry, there must be 2 accounts affected. One must have a debit entry and one must have a credit entry. In other words, for every right hand you have, you must have a left hand. For every left entry, you must have a right entry. So on your next 2 pages, you will see that the one is labeled dead and the next page is labeled CLIC. So just look carefully which page we are on. So let me illustrate this double entry principle to you. So let's say, I'm just going to make up transactions as we go, that the owner contributes money to start the business. So start your questions. The 2 accounts that are affected were bank. So on your dead page, let's write bank. And the owner contributes, so that's capital. So on your CLIC page, we write capital. Okay, you can abbreviate if you like. Now, let's go back to bank. Let's say he contributed 100,000 Rand. I'm going to put it on the left-hand side of bank. Can you see I'm writing near to that little line down the middle? Oh, sorry, if I can go back just a second. So on the left side of the T account, you put your 100,000 Rand, and I'm going to write a word there now. So just leave a space there. And I said to you, for every debit, you need a credit. So if the bank is being debited, then capital is being credited. And again, I'm leaving a space to write a word there. Alright, so I'm just going to number them. This is transaction 1. This was transaction 1. In accounting, we'd like to show the double entry within one account. So in that space where we've left there, it's like making a phone call on your cell phone. When I phone you on your phone, I will see your name. Now, let me try that again. That doesn't work so well, hey? On my phone, when I phone you, I'll see your name. On your phone, you will see my name because I'm phoning you, right? So similarly, in the bank account, you want to say, well, if every debit needs a credit, and if the debit is in bank, where is the credit? Who are you phoning? Then you will say, well, the credit lies in capital, cross-reference. So in bank, you write capital, and in capital, you say, okay, well, if this is the credit, where does the debit lie? You cross-reference and you say the contra account, the other account on the opposite side, is bank. So in capital you write bank, in bank you write capital. On your phone you've got my name, and on my phone I've got your name. Do not phone yourself. Don't write bank in bank, because then that's sad. Okay, you don't phone yourself. And you don't write capital in capital. The contra account, the other account. All right, so now let's go and receive money another way. Let's say the bank lends us some money. So I'm receiving money, so my one account is bank, and I'm borrowing money, so the other account is loans. I've already got a bank account. Let's go to the CLIC page and let's write loan. All right, so in my bank account, when I received money from the owner, I put it on the debit side. And when I receive more money from the bank, I'm going to stay on the debit side. Let's make up the number and say I'm receiving 50,000 Rand from the banking institution as a loan. So I'm going to stay on the debit side of bank. For every debit, I need a credit, which means the loan account will have a credit entry, transaction number 2. In loan, I will write bank. And in bank, I will write loan. So basically, every account will have a side for something coming in, like bank, money coming in, or something going out. Okay, and then you stick to those sides. Let's say if we had to pay some of this loan back, then money would be going out. Let's make it 1,000 Rand. Oh no, let's make it 5,000. So that means I'm going to put the 5,000 on the other side of bank. I'm paying my loan, so the two accounts is bank and loan. For every credit, I need a debit. Transaction number 3. In loan, I will write bank, and in bank, I will write loan. So let's say, for argument's sake, let's now go and buy some equipment. So that means I'm going to pay money out. So let's make it 2,000 Rand. So that means I will credit the bank with 2,000 Rand. And I need a equipment account. So let's stay on the dead page. For every credit, I need a debit. So I'll debit equipment. In equipment, I'll write bank. And bank, I'll write equipment. Not too bad, eh? Let's go and render a service. Let's say I'm a hairdresser and I'm going to have services for the week. So I'm going to receive, let's make it 10,000 Rand. So I'm receiving money, so I'm going to go to the debit side of bank. I'm receiving money for services, so we need an account for service income. So let's go to the CLIC page and write service income. Oopsie, yeah, you can read that. So debit the bank, credit service income. Let's just put a C there. And that was transaction number 4. In service income, I'll write bank. Of course, you could have said current income. You could have said services rendered. There's very many names for the same thing. And in bank, I will write service income. I'm just going to abbreviate. Oh, we already had a number 4. Sorry, that's a number 5. Doesn't matter. Just that you know which one's which later. I'm also color coding, so hopefully you can see. Alright, let's go and buy some stationery. So money's going out. So let's credit the bank with, let's make it 1,000 Rand. Number 6. And I need a stationery account. So let's, on the dead page, open stationery. I'm just going to abbreviate stationery. I've credited my bank, so I must debit my stationery. In stationery, I'll write bank, and in bank, I'll write stationery. So while we cross-reference, if you look at your bank account, you can see I've received money for capital, I've received money as a loan, I've received money for services. On the payment side, I've paid back some of the loan, I've paid for equipment, I've paid for stationery. And you can then see what has happened without having to look at the contra account or the other entry to know what has happened. Alright, let's go and buy some more equipment. But this time let's go and buy it on credit. So in my equipment account, when I bought equipment for cash, I put it on the debit side. So when I buy on credit, I'm going to stay on the debit side. Let's make it 8,000 Rand. So debit equipment with 8,000 Rand. This is transaction 7. And I'm buying it on credit. So the account name for the people I buy from on credit is creditors. Let's go to the CLIC page. Let's open a creditors account. For every debit, I need a credit. So let's credit the creditor. Even sounds similar. This was transaction 7. In creditors, I will write equipment. And in equipment, I will write creditors. Okay. And so we could continue the whole way. Let's do one more where the owner takes some money for his own use. So money is going out, so bank will be credited. Let's make it a number I haven't used, 3,000 Rand. Bank will be credited, number 8. And I need a drawings account, so my last little account that I haven't got something in yet is drawings. For every credit, I need a debit. In drawings, I'll write bank, and in bank, I'll write drawings. There you go. Alright, so you've got an idea of how the double entry system works. And as I said to you, one side of the account will be for money coming in or the bank getting bigger, and the other side will be for money going out or the bank getting smaller. Equipment got bigger. If I had to return it or sell it, I'd put it on the other side. Stationery coming in, stationery going out. More drawings, less drawings. Now you say to me, but can't we just remember that debt is the plus? No, debt is not just plus. Let's go and look at the CLIC page. More capital, this time went to the credit side. So if I had to cancel capital, it'll be on the debit side. But hang on, we learned about drawings already, and drawings is the opposite of capital. So that means drawings should be on the debit side. Let's go and have a look. Ha! That's exactly where we put drawings. Can you see they are opposite to each other? The loan went up on the credit side, and when I paid some back, it went down on the debit side. More service income, and if I had to refund somebody because of whatever reason, it will be less service income. More creditors, and if I had to pay them, less creditors. So you can see that debit does not mean plus or increasing. Debit means left, credit means right. So how are you going to learn which accounts get bigger with debits and which accounts get bigger with credits? So if you go back now to that page I didn't finish filling in, my two little acronyms, DED and CLIC, are going to help you. The accounts that get bigger on the debit side are expenses, assets, and drawings. Expenses, assets, and drawings will get bigger with debits and smaller with credits. So if the D stood for debit, the C stood for credit. If the A in DED was for assets, the L would be for liabilities. If the E was for expenses, the I is for income. If the D was for drawings, the C is for capital. So DED says debit expenses, assets, and drawings to make them bigger, which means you will credit them to make them smaller. CLIC says credit liabilities, income, and capital to make those accounts bigger, and a debit will therefore make them smaller. So if you look a little bit further down the page, it's exactly what it says here. Expenses, assets, and drawings will get bigger with debits and smaller with credits. CLIC says liabilities, income, and capital will get bigger with credits and smaller with debits. So let me illustrate that to you with a few T accounts. Let's say you've got assets. Now if you don't know which accounts are assets, in other words you haven't learnt your lists in study unit 2 and 3, then DED and CLIC's not going to help you. Assets fall under DED, right? Debit expenses, assets, and drawings, which means debit your expenses, assets, and drawings to make them bigger, and credits will make them smaller. Let's go and look at my little example here. Bank was an asset, got bigger with debits and smaller with credits. Equipment was an asset, it got bigger with a debit and smaller with a credit. Let's go to the other side of that and look at my accounting equation. Assets equals owner's equity plus liabilities. I just want to move that to a bit more to the right hand side. So any liability account. So of course if you haven't learned which are liabilities, you have a problem, don't you? Liabilities fall under CLIC. Let me just make it a bit smaller. Yeah, where's my mouse gone? There we are. Hold on a sec. Don't need it quite so massive. Liabilities fall under CLIC. Credit, liabilities, income, and capital, which means liabilities will get bigger with credits and smaller with debits. All your liabilities. So if you go and look on your CLIC page, you will see loan was a liability. It got bigger with a credit and smaller with the debit when we paid it back. Creditors is a liability. It got bigger with credits, and smaller with debits. So all liabilities. But if you don't know your lists, this doesn't help you at all. So far, Dead and Click tells you which side accounts get bigger or smaller. Let's look at owner's equity now. I'm not writing very prettily, so just follow more or less. Owner's equity, as a general rule, will get bigger with credits and smaller with debits. Things that increase owner's equity is income and capital. That's why they're on the credit side. Things that decrease owner's equity are expenses and drawings, and that's why we will debit them. Okay, does that make sense? All right, so let's go into that a little bit further. We said capital will increase equity. Income increases equity. Capital and income, they both fall under CLIC. So to increase capital, you will credit liabilities, income, and capital. And to decrease it, you will debit. To add to income or to make income bigger, you will credit it. To make it smaller, you will debit it. More capital, more income has the effect of increasing owner's equity. So far more is more and less is less. The only two that are the opposite way around is the opposite of capital is drawings. Oops, daisy. And the opposite of income is expenses. Drawings and expenses both fall under dead. Debit expenses, assets, and drawings. Debit expenses, assets, and drawings, which means you will debit drawings to make it bigger, you will debit expenses to make it bigger, and therefore you will credit them to make drawings and expenses bigger. Drawings is the opposite of capital, so can you see the pluses are on the opposite side? Income is the opposite of expenses, so the pluses are on opposite sides. Now the only thing that could confuse you is more drawings is decreasing my equity. More expenses will decrease my equity. More of a bad thing is bad for the owner. But if you don't know which accounts are income and expenses, you have a serious problem. Let's go and look at my little example. Those two were assets. Stationery is an expense. So I made stationery bigger with debits and smaller with credits. You could also have seen it as an owner's equity account. Owner's equity gets smaller with debits. More bad stuff makes the owner poorer. And owner's equity will get bigger with credits. So it doesn't matter which way around you look at it, expenses are on the left. Drawings gets debited to make it bigger. The next page, capital gets credited to make it bigger. Service income is an income. CLIC says credit income to make it bigger. You could also say equity gets bigger or increases with credits and decreases with debits. There's so many different ways to remember it, and if you learned a different way at school, stick to that. Just keep it simple for yourself. Alright, so I hope Dead and Click helps you, but if you don't know your assets and income and expense accounts, then Dead and Click's not going to help you at all. Alright, and that's basically just hopefully assisting you with your debits and your credits.